Hello, smart spenders. Let's talk credit scores. Hello, everyone. It is so important that we talk about something that touches every single one of your financial lives. I am talking about credit scores. Now, I know many of you hear credit score and you immediately feel a little bit anxious, a little bit confused. But I am here today to tell you it does not have to be that way. We are going to demystify this whole concept, make it crystal clear for you. Think of your credit score as your financial report card. It is a crucial indicator of your financial health, a key that can unlock so many opportunities for you. Understanding it is not scary. In fact, understanding it is empowering. We will make it simple because knowledge is your greatest power when it comes to money. Why should this little 3-digit number hold so much importance in your life? Well, let me tell you, it really does. This score can either be your staunchest ally, opening doors for you left and right, or it can become a significant roadblock, stopping you from achieving your dreams. It is the primary tool that banks, lenders, and other financial institutions use to gauge if you are a safe bet. Are you someone they can confidently lend their money to? In essence, it is a numerical representation of your financial responsibility. Your entire financial reputation can often hinge on this single number. It tells the world how well you manage your financial commitments. Today, we are going to dissect this topic piece by piece so that you understand it inside out. And I promise you, there will be no complicated financial jargon, no confusing terms that make your head spin. We are going to have a simple, straightforward conversation about what these credit scores truly are. We will explore how they are calculated, what factors influence them, and most importantly, how they directly impact your ability to achieve your biggest life goals. We are talking about buying that beautiful home you have always wanted, purchasing a reliable car for your family, or even something as basic as getting approved for a good mobile phone plan. It affects far more aspects of your life than you might initially think. So, I want you to settle in. Perhaps make yourself a comforting cup of chai or a warm cup of coffee. Find a comfortable spot and relax. Because taking the time to learn about your credit score is an absolutely fundamental step. It is the very first and arguably the most important step towards gaining genuine, meaningful control over your financial destiny. Control over your money, control over your borrowing capacity, and ultimately control over your entire financial future. This is not just information, this is about empowerment. Let us embark on this important journey of understanding together, shall we? Knowledge is the key to financial security. Alright, now that you are settled, let's get right to the heart of the matter. What precisely is this credit score that we keep emphasizing? To put it in the simplest terms possible, a credit score is a 3-digit number. This number is used by lenders, think banks, housing finance companies, non-banking financial companies, NBFCs, and even some digital lending apps. They use this score as a critical tool to help them decide whether you are likely to repay any money that you borrow from them. It essentially provides a quick, standardized snapshot of your creditworthiness. It tells these institutions in a numerical way how risky it might be to extend credit or a loan to you. In India, these credit scores typically fall within a range of 300 to 900. You will often hear about the CIBIL TransUnion score as it is one of the most widely recognized and used credit scores in the country. A score that is closer to the 900 mark is considered excellent, absolutely fantastic. It signals to lenders that you are a highly responsible borrower, someone who manages their debts impeccably. Lenders will be very keen to offer you credit products, often on favorable terms. Conversely, a score that hovers closer to the 300 mark is considered poor. This indicates a high level of risk to potential lenders, and you will find it very difficult to get loans or credit cards approved. It is crucial to understand that this score is not just some arbitrary number plucked out of thin air. Oh no, it is meticulously calculated. This calculation is based on the information contained in your credit history. Your credit history, maintained by credit information companies, CICs, or credit bureaus, is a comprehensive and detailed record of how you have managed your debts and credit obligations in the past. It includes information about all your loans, such as home loans, auto loans, personal loans, and education loans. It also tracks your credit card usage, including your payment patterns and outstanding balances. Every financial transaction related to credit is systematically recorded and updated. In India, there are 4 main credit bureaus authorized by the Reserve Bank of India, RBI, to compile this credit information and generate credit scores. These are TransUnion CIBIL, Experian, Equifax, and CRIF Highmark. While all these bureaus collect similar types of data from banks and other lending institutions, like your repayment history, credit accounts, etc., their proprietary scoring algorithms or formulas might differ slightly. Consequently, you might observe minor variations in your credit score when you check it with different bureaus. However, the overall assessment of your credit health that they provide will generally be consistent across all of them. The core message remains the same. Good financial habits lead to a good score. Now let's pull back the curtain a little further and understand the key ingredients that actually go into formulating your credit score. What are these critical factors that cause your score to go up or, heaven forbid, go down? The single most influential factor, and I want you to listen very carefully to this, is your payment history. This component typically accounts for the largest portion of your credit score. The crucial question here is, do you consistently pay all your credit card bills on time? Are your loan EMIs, equated monthly installments, paid by their respective due dates every single month without any exceptions or delays? Even one missed payment or a payment made after the due date can significantly damage your score. Lenders view late payments as a major red flag, indicating potential unreliability. The next important element is something often referred to as your credit utilization ratio, or CUR. Now, this might sound like a complex financial term, but I assure you, it is quite straightforward. It simply represents the proportion of your total available credit that you are currently using. For instance, if you have a credit card with a total limit of 1 lakh rupees, and your outstanding balance on that card is 50,000 rupees, then your credit utilization ratio is 50%, 50,000 divided by 1 lakh. Lenders generally prefer to see this ratio below 30%. A consistently high credit utilization ratio can suggest to lenders that you might be over-reliant on credit, possibly stretched thin financially, which makes them nervous about your ability to take on new debt. The length of your credit history also plays a significant role in determining your score. As a general rule, a longer credit history tends to be more beneficial for your score, provided of course that it is a history marked by responsible borrowing and timely repayments. A long and positive credit history demonstrates to lenders that you have a proven track record of managing credit effectively over a sustained period. This is why you should think carefully before hastily closing very old credit card accounts, particularly if they are in good standing and have a positive payment history. These old, well-managed accounts contribute valuable, positive data points to your credit report, showcasing stability and trustworthiness over time. Finally, other factors that contribute to your score include your credit mix and your recent credit behavior. Lenders generally like to see that you can responsibly manage a diverse portfolio of credit products. This could include a mix of secured loans, such as home loans or car loans which are backed by an asset, and unsecured loans, like credit cards or personal loans which are not backed by collateral. However, it is also important to be cautious about applying for too many new credit accounts within a short span of time. Each time you apply for new credit, it can trigger what is known as a hard inquiry on your credit report. While 1 or 2 inquiries are usually fine, a flurry of hard inquiries in a short period can negatively impact your score, as it might suggest to lenders that you are desperately seeking credit. So, we have thoroughly discussed what a credit score is, how it is meticulously calculated, and the key factors that influence it. But the big question remains, why should you genuinely care about achieving and maintaining a high credit score? Because, my dear friends, a good credit score is nothing short of a financial superpower. It is a golden key that unlocks numerous financial doors for you. A high credit score significantly increases your chances of getting approved for loans and credit cards. But it's not just about approval, it is also about the terms you get. A strong score often qualifies you for more favorable terms, most notably, lower interest rates on your home loans, car loans, and personal loans. Just imagine the substantial savings. Those lower interest rates can translate into saving you thousands or even lakhs of rupees over the entire duration or tenure of a loan. That is a significant amount of money that stays right there in your pocket. Money that you can then use for your other important financial goals, for your family's well-being, or to build a more secure future. Beyond just loans, a good credit history can prove to be important in other, sometimes unexpected areas of your life as well. For instance, some landlords might review your credit report as part of their screening process before agreeing to rent you a flat or a house. Furthermore, certain employers, particularly those in the finance sector or roles involving financial responsibility, may also look at your credit report as part of their pre-employment background verification. It serves as a broader indicator of your overall reliability and responsibility. Now for the really empowering part. What concrete steps can you take to improve your credit score or to maintain an already good one? The absolute number one non-negotiable rule, always and forever, is to pay all your bills on time. Every single bill, every single month without fail. This includes your credit card dues, your loan EMIs, your utility bills if they are reported, everything. Make use of technology, set up payment reminders on your phone or calendar, consider automating your payments through standing instructions with your bank, if that helps you stay consistently on track. This discipline is the absolute bedrock, the very foundation of a healthy and robust credit score. There are simply no shortcuts around this fundamental principle. Secondly, make a conscious effort to keep your credit utilization low. As we discussed, aim to keep it ideally below that 30% threshold of your total available credit limit. Avoid maxing out your credit cards month after month. Focus on systematically paying down your existing debts. This not only improves your utilization ratio, but also reduces your overall debt burden. Also, cultivate the habit of reviewing your full credit report at least once every year. You are legally entitled to receive one free credit report annually from each of the credit bureaus. Scrutinize it carefully for any errors, discrepancies, or inaccuracies, and if you find any, get them rectified immediately by reporting them to the bureau and the concerned lender. Remember, a good credit score is not merely a number. It is an indispensable tool for your financial well-being, your independence, and your empowerment. Cherish it, nurture it, and use its power wisely.